Hey everyone, so this is Addy again. I apologize, my camera for some reason is not working right now, so I've decided to record it without the camera. But the topic of to take you through the best strategies for options trading, things that have worked for me in the past, and I want to show you how I've traded these strategies and how they've actually worked for me in terms of defined risk, defined reward. That's the whole idea behind this video. So the problem that I keep receiving from my followers, from my subscribers, is that they get themselves tangled into too many tickers, too many indicators, and too many strategies at the same time. Now, personally, I only focus on a couple of strategies, only three mainly, maybe four. I don't have any indicators on my watch list. I don't have any the list of tickers that I trade are probably around 15 to 20 max. I don't trade more than that, and that's the reason why I believe I've been successful in this option selling side of things in the last couple of years. Don't get me wrong, I've been doing this for the last 10 years. The first 4 or 5 years was just a learning curve. I lost a lot of money, and then eventually I figured out and zeroed in on a couple of different strategies, and then I've stuck to them because those guys have actually worked better for me. So my suggestion to whoever is starting out right now or whoever is doing this is to stick to a few tickers, no indicators, and one or two or three strategies max. Now, the way we set up these strategies, we find high probability of profit trade, meaning the way we set these things up, because remember, the entrance is all in your hand. You cannot blame the market, you cannot blame the watch list, you cannot blame the indicators or anything, because setup going into the trade is all on you. So you have to make sure that the setup is correct. You've checked everything, you've selected the right strikes, the right expiration cycles, and the right ticker, because liquidity matters the most in this business. In this world of options trading, liquidity matters a lot, because think about rolling the trades when they go wrong, because there's an adjustment process, the rolling process, the mechanical process that we follow when things go wrong. So we have to make sure we are in the liquid underlying tickers. So what do I mean by that? And I'll take you through the platform to show you exactly what I mean by these strategies. But this is the theoretical part first. We have to cover this so that you understand the basic mechanics of these strategies. My first one is a credit spread. Now, whether it's a bull put or a bear call, these are credit spreads. You sell the premium and you sell into the strength of the market, meaning whenever the market is down, you sell put options. When the market is up, you sell call options. The way it works is you collect time decay on these strategies. You enter the trade as a contrarian, and then you wait until the IV crush happens, and then you sit and wait in these strategies to collect the theta decay. Now, the decay curve, as you all probably know, and if you don't, just watch some other videos I've made, the max theta decay happens in the last 15-20 days, which also means that the options are designed to move really fast in the last 20 days. And therefore, we try to avoid that part of the decay curve. We try to collect the decay in the first 20 days of the curve. Now, this is how the bull put strategy is set up. You sell a put strike, and then you buy a put strike further out of the market. And I'll show you exactly on the platform what I mean by this. The break even is basically the put strike that you're selling minus the credit that you receive on that put strike. And then whatever credit you receive becomes your max profit, and your max loss is between the width of the strike, the width of the strike minus the credit that you collect. That becomes your max loss. Meaning, if the width of your short put and the long put is $10 and you collect $2 on their strike on the premium, then your max loss is $8. And in the options world, that means $800. The bear call spread strategy works the same way. You sell one call strike and then you buy one further out of the money. And that's how the bear call strategy works. Similar criteria here as well. The break even is then lower than your short strike, and your credit, the max credit, becomes your max profit. Now, for example, when I was doing this slide, the ES was trading at 5,700. This is just an example, a 25-point wide strike, 25-point wide spread. You collect $150, your max loss becomes $1,100. And I'll show you on the platform what I mean by this $1,100. First, let's go through the entry criteria here. The 30 to 40 days to expiration is what my sweet spot is. Maybe a shorter time scale, a shorter duration works better for you, but this has always worked for me because it gives you duration. It gives you a chance to roll and manage the trade if it goes wrong. The strike that I select on the short side, the strike that I sell, is between 17 to 20 delta, meaning it goes from 17, 18, 19 to 20, somewhere in between there, depending on where the market is. The IV rank has to be high, but not too high, because IV does not always in a high mode. Most of the time, the IV is really low. It really trades, lower overall, because that's how the markets are designed. The markets have a positive drift to it. There are more buyers in the market than sellers, and therefore, whenever the market goes up, the volatility goes down, and therefore, you always have this lull state of volatility most of the time. The exit rule is basically very simple. You close the trade out when you've collected 50 to 70%. 70 is on the very high range. It rarely happens, but 50 is our target. Anywhere lower than that, 40 is also fine, 40% of max profit. So let's say you sell something for $2, you should close the trade out at $1 when it's trading at $1. That's how you close the trade. Now, the second one is a covered call. Again, if you hold some shares, it makes total sense to sell some premium on it and collect some extra cash. And when I say collect premium, I mean, let's say you have Apple stock at a cost basis of 200 and you're willing to let it go at 230 or 240 or 250. You will sell a call at that strike. You won't just sell the shares in the market. You will sell a call at that strike and let the stock be called away from you. And therefore, when you do that, you will collect the premium, you will keep the premium, and you will let the shares go. Because you were going to let the shares go anyway at 250, so why don't you just sell some premium on it, collect more money, lower your cost basis, lower some volatility of the position, and then let it. This is how the covered call strategy works, because it caps your upside. When I say cap the upstrike is whenever you sell a call strike, that's where it caps it. That's where it caps your profit, because at that point you will lose the shares, meaning the shares will be called away from you. Entry rules again: if you hold, sell it. If you hold the stock position, sell it 30 days out. I normally do 40-45 days, stick to the monthly cycles, and I would sell around 30 delta, which is about 20% out of the money. You can sell closer to the market, which is 5 to 10% out of the money. I've just put general numbers here. My go-to would be 30 delta for covered call if I'm willing to let the stock go. Now, the last one, my top 3 strategies, is a cash secured put, meaning if you hold some cash and you want to buy some stock, don't just go out in the market and buy the stock. You should sell a put on it and let the market come to you. Now, here's the backdrop of it. The drawdown is that you may never get filled, meaning the market will just keep running away from you and it will not hit your put strike. It will not come down to your put strike, which is fine. If it keeps running away from you, you keep selling premium and you keep collecting premium. That's one way of doing it. Now, if you really want the stock right now and also want the premium, you would sell somewhere closer to the market, around 30 to 35 delta. And I'll show you on the platform what I mean by that when we go and check it out. Now, cash secured put is very powerful because I think you're entering long positions at a discount, meaning you're always lowering your cost basis. You are getting the market to come to you instead of chasing the market at the market price or even higher. And you generate income because you're always collecting some premium. Now let's go onto the platform and then look at these strategies in practice. One thing I want to discuss before we go onto the platform is on these slides, and I will link up these slides in the show notes, just so that if you want to download these slides, you can do that. This is how the 3 strategies stack up. On the credit spread side, you always have some net positive or negative delta, depending on whether you're bullish or bearish, whether you're selling puts, or the put spread, or the call spread. You always have positive theta, meaning because we're selling the options, we're always positive theta. IV is negative, Vega is negative for us. We want the IV crush, meaning IV has to come down for us to make money. Gamma is really low because we have 45 days out, 30 days out. Okay, if you look at the gamma line here, we are always low on the gamma side because we are selling way out of the on the expiration side. Covered call, again, you're positive, long stock, and your short call will collect some negative delta. But overall, you'll be long. Long delta is here, meaning you will go, your position will go up, will make money if the stock goes up. Okay, theta will always be positive because again, you're selling the call. And Vega and Gamma will remain the same as the call spread. Cash secured put, same thing. You are going long the market, so you have positive delta. Now, if you don't understand any of this, just message me, send me an email, whatever, and I'll respond back to you, and I can explain more on this. Go through these slides and then learn more about these strategies, and then let's look at them on the platform right now. Okay, so here we are talking about these strategies on the platform actually. So let's go through some examples. So right now it's around 9:40 p.m. Pacific time, so the market is actually closed, but the futures market is open. So we look into the futures market and then set up some trades. These are just sample trades. Don't go for the fill prices that we get, because on the simulated trading account that I'm showing to you right now, the fills are not really real. They are very close to the real market, but they're not real. So this is just for practice purposes. So first of all, let's talk about a short put spread in the S&P 500 futures market, futures options market. So I'm going to select the 32-day cycle because that's what's available right now. The next one out is 60 days, which is a little bit too far out for me. So I don't, and I got my camera working, by the way. So it's the same video, but the camera just wasn't working before. Okay, so I'm going to look into the 32-day monthly cycle and look at the open interest. That's the first thing I look at. Look at the thousands of numbers here. That's what we want. For comparison, if you want to look at, let's say, one of these week 4 ones, look, these guys are in hundreds, so we don't touch these. So I always go into the monthly cycle, which has the highest number of liquidity. So always remember that you need to have this kind of liquidity because you need to know that you don't want to lose on the bid-ask spread when you roll and close these trades. Also, one thing that just popped out to me was look at the open interest around these strikes, like 4,000 level strikes. These guys are like in 90,000, 40,000 levels, meaning people, there's always a put skew in this S&P 500 index. Go down and then come up to which means that people have bought or sold these strikes more than any other strikes here. There's a lot more interest here than anywhere else on the curve. Okay, let's set up a 17 delta short put spread, and then I'll take you through the call spread as well. So 17 delta is 5,700. The current price is here, 59.65. Right click, sell a vertical. Okay, and I want to show you exactly what I do to enter the trade. The first thing is I always go in with like one contract first. That's the whole idea. Then right click and then analyze the trade just to see if everything lines up, meaning your break-even points, your max profit and everything. Let's just look at them here. So when you change the date to break-even here, you have to change it here as well on top. Otherwise, your chart will not look right. So you have to bring in the expiration cycle. Now look, this is the number I was talking about. This is probability of profit. Let's get it back. Let's get it back to break even. 85%. You have an 85% chance that the underlying will stay within this grayed range, the grayed out area, which is your profit zone. So there's an 85% chance that you can make money on this. Right now, the volatility is not, and then we are only 32 days out, so you will not collect enough credit here. Usually, I would go for maybe 3.00, which gives you at least $150. That's how the S&P 500 futures work. What else? So your max loss again is your 25-point width of the strikes. This is the width of the strikes, 5,700 and 56.75, and then you deduct the amount of credit that you collect. So it's trading at 250, which is about 120. You also have to half this to get the actual dollar amount in this ticker. So this is how we set up the short put spread. You check your max loss, you check your max profit, you check your Greeks. Now let's look at the Greeks one more time. You have to look at the main, the center position here. You are collecting small delta, basically no gamma here, positive theta and short vega because you're shorting the option. So you are collecting short vega, and then your open position is nothing. Anyway, this is how you set up a short put spread. Now let's go and look at the short call side. So I can show you both sides here, and then we will go and look up a cover call and cash secured put. Okay, short call side, again, I'm going to go to 18 delta, 62.50 is what I'm getting, vertical. Now notice on the short call side, your pop will be slightly lower, and I'll tell you why. Because, like I said, there's a put skew in this market, so you always get a good put position on if you sell the put side. But on the call side, you will not always cover your expected move. Let's take a look at this. So see, your gray area is slightly over your break-even point on the call side. That's how it always works on the call side, because there's a lot of put skew in this market. So your put side will always give you that one standard deviation move. The call side will not always give you that. The gray area is slightly beyond your break-even point. Ideally, we would like everything within the break-even point, but sometimes that does not happen. So anyway, this is how the call side stacks up. So you see your pop is slightly lower because you're not covering the whole gray area here. If this was covering the whole gray area, this number would have been around 83, 84%. Right now it's 78, which is also a very good number, don't get me wrong. You're collecting more credit here because the market is on the upside. The risk is on the upside right now. Therefore, the calls are priced higher than the puts in the same expiration cycle. Okay, that's the reason why you're getting more money to sell the calls, because it has the call skew on it right now. It has the positive drift. The risk is on the upside. Okay, the next strategy is a cover call. Now let's say, let me bring up Apple stock. Okay, it's trading at 208. That's a good number. 32 days out is fine for a cover call. So let's say you select, I'm selecting a 27 delta call here at 220. Right now, I'm expecting that you have a stock position already on, and therefore you are selecting this strategy. Meaning, I did the wrong one. I did the covered stock. Can we do a covered call here or no? If not, I can just set one up like this. Okay, let's do an ask of 100 stock. Put this in our analyze tab. Now let's bring in the call side. So I'm pretty sure you were able to do it. A covered stock. This gives us, yes, this is the one that we wanted, right? Okay, so this is a covered call strategy that you can enter as one trade on this platform. So you don't need this one in stock. We need this. Okay, so what is happening here? Now we are buying 100 stock as well as selling a call option. Okay, now look at the max profit on the call option because you're selling the call for. Let's break down the call price. The call price is the strike that we selected. The call price is 255. Okay, so it does give you the right one. Okay, 255 is the call side. We're selling a call and we're buying some stock. This is how the chart looks for a cover call. I think this is a little bit more confusing for my audience probably. So let's just bring in the simple one stock here, 100 stock, and then let's bring in the call side. And I'm selling it at 27 delta. Let's take a look at one call option. Okay, here. So this is the chart that we were looking at before. The call, you'll be paying some, let's say you own 100 Apple stock. This is how you would sell a call on it for $247. And I would look to collect $100 to $125 from it and then move on. This is the cover call position as we call it. Look at the max profit. It will cap it out at, wherever your strike is plus the premium. So your break-even point becomes this kink here, not break-even, sorry. Your capped profit becomes this kink here. You have sold a 220 strike, right? So 220 plus the $2.47 you collected is where your max profit will be. That's the max profit line. And then on the downside, obviously the stock can go to zero, so your max loss is obviously the whole investment gone. Meaning the $100 times whatever price you paid for it, 100 stock times whatever price you paid for it, plus the premium that you collected, $247. So you can keep that premium. Okay, next one. Let's look at the cash secured put. Now, the reason I would do a cash secured put is because I have some cash and I want to buy some stock. But instead of just buying it outright, I would go out and sell a puts option on it so that it gets put to. So in that case, I'll just go and say, well, I think this stock can go down below 195 or 200. Right, so I'm going to sell it at 200. I like that strike. The delta is 30. There's good open interest. Look, 45,000 interest here. Contracts, which is a good number. So I'm going to go and sell it for $3.30. And I'm just going to sell a single. And that's a secured put, meaning you're securing this position with your cash. But obviously, you don't have to put down all of the money. You will only be debited all the money if the stock comes to you. If you want to look at the margin numbers, go confirm and send and look. You're putting down $20,000 to initiate this trade. You are collecting $315 minus the 65 cents for each contract that you sell or buy. That's the price of the option that you pay here. Commissions that you pay on this platform, at least in my account. So that's how this cash secured put is. It's pretty much similar to like a cover call, but if you have some cash, and then let's say you get assigned here, you get this assigned this stock, then you can go out and sell the calls. And that's how that's what becomes your real strategy. You get assigned some shares, and then you sell the call side, get the call, to get the calls, the stock get called away. But here's the catch in that strategy: let's say this thing gets assigned to you at 200. Okay, if the stock is below 200, below your cost level, below your cost basis, meaning let's say it's trading at 180 or something. Now you will not get enough credit to sell on the call side because now the stock is dropped. So if it drops below your cost basis, you then have to wait for the market to come up to you. When it does, then you start selling the calls again and then let it get called away. So that's how these three strategies stack up. If you are a beginner, you're an intermediate trader, advanced trader, let me know. Have any questions, just drop it in the chat on the channel. And I hope you like the content. If you do, please subscribe. Thank you very much.